Okay, well, good morning, good afternoon, depending on your time zone. Welcome to the quarterly equity call of UTI. My name is Praveen Jagvani, and I'm responsible for the international business of UTI. We have over 150 participants registered for this call today from more than 24 countries, spanning time zones, starting from Japan and Australia in the east, covering all of Asia, Middle East, and Europe, through until United Kingdom and Ireland in the West. On behalf of UTI and all my colleagues, thank you very much for joining us. I know that some of you have sent through questions you wish answered by our expert panel, but in case you wish to ask some now, I will request you to key them in as messages on the Zoom facility. These have been perplexing times, both at the individual level as well as for the global economy. In the past few months, there have been, I would say, three main trends common to the world as well as India. Number one, of course, is the continuing spread of COVID virus and all its variants and all the conversation about the efficacy of different vaccines. Each country has had its own unique glide path of waxing and waning waves of COVID. But the consensus is that this coronavirus is now a known devil and that eventually humanity will prevail, though in the short term, there could be more pain and frustration. So that's sort of the key trend, literally unifying the world. The second trend is that global investors and indeed Indian investors are looking past the short-term disruption caused by the pandemic and have demonstrated a belief that this too shall pass. Thus, most global equity markets are rising steadily, as are Indian markets. Corporate earnings across the world, US, Europe, and India have been stellar. As a result, the investors have been encouraged even further to take the markets even higher. So that's a second trend. Rising corporate earnings and investors not shaking their faith in equity markets. The third trend is the rising specter of inflation. Again, common to both the world as well as India. It remains to be seen how much of this inflation is due to supply disruption and therefore temporary, or is it indeed a structural shift that could launch us into a rising interest rate cycle quicker than anticipated. The rising commodity prices only add another dimension of challenge to this trend. What all of this means for India and Indian equities, we will hear shortly from my colleagues Ajay and Vetri. First up is Vetri Subramaniam, who has been a keen participant of Indian markets for coming close to 3 decades now. He's the head of equities for UTI Group, and he will share with us his perspective on the Indian economy and markets. Vetri, over to you.
Sure. Thank you, Praveen. And I understand we've had some technical difficulties, but okay. I think we've now got Ajay on the call as well. So Vishal, if you just want to pull the slides up on the screen, then I think it'll be easier.
Definitely.
Yeah, great. So we can just move to the third slide straight away. Yeah. So I guess, as Praveen made the point, no discussion these days can commence without some reference to COVID, and whether it's the first wave or the second wave, or in some cases the third wave. I think the good news from India's perspective is that there are now clear signs that the second wave is ebbing. Even this data is about a week old, and I was just looking at the papers this morning, and the COVID-19 case count has continued to come down over the course of the last 1 week. And I, of course, live in the city of Mumbai, where we had some pretty intense restrictions right through late April, the month of May. But beginning last weekend, they've gradually started to unwind some of those restrictions, not yet fully back up to speed, but I think by the end of this month, there's some clarity that we will get back to more sort of not normal, but let's say as near normal as is possible, given the fact that COVID continues to be a threat. The Google mobility trends already suggesting that the worst is behind. And since I went to the office yesterday, I can vouch for the time I spent in traffic. Without doubt, things have started to pick up again. The second wave, at a very sort of personal and human level, is been very, very difficult for all of us. We've lost colleagues, we've lost family members, and within the circles of near and dear, whether it's colleagues, whether it's neighbors, whether it's friends, family, there are no 6 degrees of separation from loss. It's the first degree of separation. So it's been painful in terms of the loss of human lives, but as Praveen said, thankfully, with the miracle of modern science, and a pickup in the vaccination program, hopefully we'll be able to put this behind us, and the medical fraternity as well, perhaps now in much better situation to deal with the risk of third wave whenever that were to come, if at all it does. So moving on, what's happened to economic activity? If you just go to the next slide, Vishal. Yeah, thanks. So this just tracks the economic activity in India across a few parameters. The sales of two-wheelers, motorcycles and scooters, sales of four-wheelers, GST related e-way bills. Remember, every time goods now manufactured and leave the factory gate, you have to generate the e-way bill. So it gives you a good sense of the extent to which the manufacturing sector is, clocking in capacity utilization, electricity generation, and finally, export data. And the blue bars reflect the drop in activity during the first wave last year, and the green bars reflect the drop in activity over a 2-year period during the second wave that we saw in these last 2 months. I think what's very noticeable is that the second wave setback has been a lot more limited. But there are also some very interesting distinctions here. During the first wave, remember, the manufacturing sector was virtually shut down as part of the lockdown, whereas during the second wave, actually many manufacturing units were allowed to continue operating, even though some may have chosen to go in voluntarily for shutdowns or reduce their production capacities because there were shortages of labor. But net, the impact does not seem to have been as dramatic. And very interestingly, we'll talk about this later, when you see that last set of 2 bars, exports have actually turned in a positive trajectory this time, largely because, once again, as I said, the lockdown was not complete, it was not 100%, and global demand has certainly come as a boost for many domestic manufacturers. Moving on to the next slide, Vishal. Yeah, I think there's been significant monetary support in India as well to the economy during these difficult times. Not as generous, we can't be as generous perhaps as the developed world, the kind of monetary stimulus that the US Federal Reserve has given. But as you can see on the left-hand side, the M2 growth has remained very, very strong. It's actually the first time in many years that M2 growth is tracking ahead of nominal GDP growth. So conditions have been easy. And you can see that on the right side, where credit conditions, unlike during the first wave where spreads actually climbed up, this time during the second wave, actually spreads have continued to go down. I think this partly reflects the fact that corporate profitability has been very, very strong, as we saw at the exit point of this year. And particularly, a lot of leveraged businesses in the commodity space have generated record profits. They've actually paid down debt. And maybe that's one reason why, particularly among highly rated corporates, conditions have been so easy when it comes to the credit market. Moving on to the next slide. Yeah. Praveen made the point about inflation. Of course, inflation is a concern, I think, to central banks all over the world. The current thought process of the Monetary Policy Committee in India, much like it has been the case elsewhere, is that these pressures are transient. The economy is not operating at full capacity. There is, so to speak, a positive output gap, and therefore they are willing to look through some of the inflationary pressures, particularly as regards farm goods. This is very interesting because we've seen a large spike come through in international food prices. In fact, this is the first time in many years that international food prices have actually gone above their level in India. And while this will create some pressures for the policymakers in terms of inflation, the good news on the right-hand side, as we can see, is that typically this amounts to a shift in the terms of trade in favor of agricultural produce and therefore the farm sector. Very positive for farm incomes. And we saw this even during the period 2006-2014, which was actually the period where prices made a very significant contribution to the strength of the farm sector, farm incomes, and therefore rural consumption in India. So yes, there will be both positives and negatives associated with this, but this is something that I think at this point policymakers are not looking at very negatively. Moving on to the next slide. I think the global growth recovery at this point of time is really what is helping the domestic manufacturing sector. There is a regular sort of high degree of correlation between global PMIs and the trend in India's exports. We can see that over here. Remember, even on one of the previous slides, we actually saw that during the period of the lockdown, one of the areas of activity that actually stayed in positive territory was exports. And I think given the second wave, right now, clearly exports are an area of strength for the domestic economy. Gradually, as we get through the period of reopening the economy, I think domestic consumption of goods should come back slightly strong, and domestic services, and I think the service sector has problems globally because of this whole issue of social distancing, that will perhaps take the longest to sort of get back to some kind of normalcy. So that's going to be the progression. I think in the very early stages post the second wave, it's really exports which are providing positive momentum to the Indian economy. Moving on to the next slide. Very quickly on earnings, what you see on the left-hand slide is the blue line, which is the trend of the Nifty 50 earnings post the pandemic last year. And as you can see, there was a dramatic collapse. However, this year, even through the second wave, that light green line on the left-hand side has not really started to come down. They've been pretty resilient, the forward estimates. Now, you could argue that, estimates are best taken with a pinch of salt, and I tend to be sympathetic to that view. But the reason why the estimates have tended to be resilient is actually in that right-hand side pie chart, where you can see that commodities and exports account for about 43% of Nifty earnings. And these two areas have been very, very strong in terms of their outcomes. And I think particularly as far as commodities are concerned, record prices, record profit margins, that's what is, giving a significant degree of support to overall Nifty 50 earnings at this point of time. I think there will be some cuts to overall earnings estimates. They are at almost a 40% growth rate in FY22, which is the year ended March. So I think there will be some cuts given the lockdown we've had through this first quarter. It's not been a nationwide lockdown, but many significant producing and consuming states were affected. So there could be some cuts, but it will get set off by those two constituents. So very quickly, just to summarize on the next slide, I think the global liquidity, the actions of governments has given confidence to markets, as has the vaccination program. India was perhaps slightly slow in getting an uptake in its vaccination program earlier this year, but I think there have been some changes for the better in recent weeks. And the finance ministry is talking about having 70% of the adult population vaccinated by Diwali, which is a big festival in India in October, November. So that's the sort of target they're working with. And just yesterday's news, we know now that the Russian vaccine has also started to become available in India. And Novavax's vaccine called Covovax, which is being manufactured in India, will also likely be available domestically sometime by about September or October of this year. So, I think that's one of the things in India's favor, having 4 vaccines which can be produced domestically And now with the government putting its money and its distribution ability behind the vaccinations, hopefully that will allow the economy to engage fully. Policy remains supportive. The Monetary Policy Committee remains supportive in terms of the monetary stance. We're clearly seeing signs that as we come through the pandemic, the organized sector and companies are benefiting in terms of reduced competition and therefore better profitability and margins. And therefore, we are seeing a veritable profit boom, even as GDP remains virtually unchanged over 2 years. Corporate sector profits based on estimates over that same period would go up by almost 30-35%. Valuations have reached rich or expensive territory, and I think therefore but this is true of most markets worldwide, I think, at this point of time, and therefore there are risks related to the sustainability of growth, inflation expectations, and once again, while the market has looked through the second wave, we can't ignore risk posed to earnings from COVID. So I think those risks remain live and something that we'll just have to take in our stride. So I'll halt at this point and hand over to Ajay, who will take you through the fund strategy and positioning. Ajay, over to you.
Yeah, thanks, Vetri. Good morning, good afternoon, everyone. I think what I'll do is I'll just quickly go through the philosophy of the fund. We have a few slides on our sectoral breakup, and we have taken 2 holdings from our portfolio for discussion today. So, Vishal, can we start? Just to recapitulate, philosophy is fairly simple, straightforward. Our true north is basically the quality of the underlying business, which we measure as return on capital being substantially higher than cost of capital, and the fact that these businesses generate strong cash flows. And our key hypothesis always is that if the business is generating economic value, over time, this economic value generation will certainly translate into sustainable wealth creation for us as investors. So that's our core belief, and we never digress from that. As we go along, I'll also tell you how we have been reacting to this very sharp value rally over the last, I would say, almost a year now. The next part after solving for quality is hunting for growth, and we always look at the ability of the business or the ability of the franchise to actually continue on the growth path by recruiting more and more customers, by building more and more use cases for the product or services. Of course, on top of that, if there is an improvement in realization by way of premiumization that's happening, that's the icing on the cake. But we would not fall for the premiumization story if, let's say, the underlying volume growth is not happening. So it's important for us, like I said, to see that more and more customers are getting recruited by the business. That's how we measure the growth profile. Last part, valuation, that I've always said important for us, but we will not miss out on great businesses just because they are trading at high valuations. We'll try and understand the reasons for those. High valuations are usually a function of high ROEs and growth. And therefore, if the business is having the ability to sustain both growth as well as ROEs, valuations can remain high, provided ROEs and growth remain strong for years and years to come. In any case, still to actually have a margin of safety, our ideal way is to build position over many quarters, taking advantage of the volatility that inevitably happens even in the most attractive business or the most sought after business. Yeah, next. Our holding period, because of the philosophy that I explained, remains fairly long. We typically look at holding a business for about 8 to 10 years. That's reflected in our turnover ratio of between 10 to 15%. And I guess this slide, which is about our sectoral holdings, further bolsters what I just mentioned, reinforces what I just mentioned. Look at our key sectoral holdings over the last 12 months, and you'll see that very little has changed, despite the fact that the last 12 months has been a fairly volatile period. Firstly, on the way down, and then a very sharp recovery, and then post the very sharp recovery, long value rally. Yet our key our key conviction calls, and we are bottom up, as you know. So the numbers in terms of our sectoral holdings are nothing but bottom up opportunities. And yet, as you can see, all of this has remained constant across the key sectoral lines: banking, financial services, which is predominantly financiers who are financing discretionary consumption expenditure in India. Consumer goods and services, we are very positive on this sector. Predominantly, like I've been saying, we are still at the bottom of pyramid. There is a huge amount of underpenetration across categories. Per capita income is still $2,000 per annum. So all of these factors put together will continue providing that tailwind for consumption growth in the country, just like they have over the last 20 years. IT is the only export facing or export focused sector that we have in the fund. And I think India's claim to fame, if you see, has been its IT prowess. The fact that if you look at the top 10 IT services companies in the world, 5 of them would be from India. And India has had a very, very strong positioning in the ever-changing technology landscape around the world. Indian IT services companies have been enablers to the big global companies whenever technology changes have happened. And the huge shift that's been happening in the last 3-4 years, which we call as digital technologies loosely, which predominantly is migrating to the cloud, but also includes a lot of data analytics. It also includes having strategy on the web. So Indian IT services companies have been at the forefront of this change, and therefore will continue to show strong growth, not only in this cycle, but our sense is continuing into future cycles whenever technology shifts were to happen. Pharmaceutical, it's a quasi-consumption theme. I've been saying this to many of you in our previous interactions. Again, the theme for both pharmaceutical and the auto industry, auto being a consumer discretionary sector, is very similar to the broad consumption theme, which is as per capita income and disposable incomes increase, people will actually go out and buy different categories of products. They would want to associate themselves with the brands, with the more aspirational brands, and therefore the shift within consumption patterns, the shift from unorganized to organized, will also lead to be a driver of growth. Healthcare services is the new position that we've built all only in the last 3 years, and these are predominantly 2 diagnostic companies. Again, in the overall theme of healthcare, it started from people testing themselves for various sickness or illness, but it is now very quickly adding a very strong stream, which is testing oneself for wellness, which is the more sticky biannual kind of tests that that many households in India have also started to do, and this habit surely would percolate down. The broad theme from this picture, our view on the key businesses that will continue to generate economic value, compound economic value, has not changed post-pandemic, as is evident in this slide. Our portfolio positioning has also not changed. We have not felt the urge to move out of consumption and move into commodities, move into oil and gas, because these sectors have done very well in the last 6-7 months. We know these are extremely volatile sectors. They were lying deep into value territory. Therefore, they've made a very significant catch up in the last 6-7 months. Can that catch up continue over the next 6 months? Possibly, yes. Would we want to increase, or would we want to build any exposure into these names, some of these names? The answer is an unequivocal no. We don't see sustainable value generation from majority companies in this sector, if not all companies. Therefore, we would stay away from them. Next, please. Yeah, Vishal, next slide, please. This is the portfolio. As you can see, the top 15 holdings of the portfolio. Here again, the same story. Nothing much has changed in terms of our top 15 holdings, as you can see. Of course, we've introduced some new stocks, which we will discuss later. But as far as the top portfolio is concerned, a few names which have actually done very, very well in the last 12 months would have gotten themselves into top 10 or top 15. But there isn't any big shift that we have done in order to either scale up a few exposures or scale down from the top 15, 20 at least. Next, please. So the next one is basically the new ideas that we have introduced. Let me first talk about the exits. These exits basically are either names where we thought that growth is lacking, or we thought that the quality attributes are not as strong as we had imagined them to be, or in case of the last two names, which are basically auto exposures or auto ancillary, so to speak, which is Igarashi Motors and Amar Raja. We thought that the way the entire auto industry is shaping up, these businesses over the next 5 to 7 years will face a challenge. The challenge may not be evident immediately, but yes, there is a big challenge to the future of these companies in terms of sustainability of growth. And therefore, at some point of time, their multiples and their valuations will start to derate. And we thought that if we anyway are not convinced, let's come out. The other three cases are predominantly cases of growth not being to the mark that we wish to own in the companies that we hold in our portfolio. On the left-hand side are the new entrants spread across the spectrum, I would say. So two of them are cases of basically export opportunities from India, either in the chemical space or the pharmaceutical space. Let me start from the top. 3M India, as we all know, is a subsidiary of 3M Global. A strong company in India. It's a consumer-facing company and always has traded at very, very high valuations. It was only same time last year that we saw a big correction and therefore build exposure. We still haven't built a very strong exposure again because of valuations, but this is typically how we behave. Great business, strong growth, we would get them into the portfolio. We'll wait for the time that we find valuations also to be attractive. Till such time we don't find valuations to be attractive, it could remain a 50-60 basis point kind of exposure. Aavas Financiers, a small NBFC, which is basically a housing finance company into affordable housing. It got listed 3 years back. Like is typically the case, we usually don't participate in IPOs. It's only after a few quarters of listing history we gain some confidence after meeting with the management for a couple of times. Likewise, Rosari, it's basically a chemicals name. And the opportunity here is not as much exports. It is the opportunity here is more domestic. And the beauty of this business has been that it has worked very closely with big consumer names in the country and has been able to gain market share surely and steadily over the last decade while having really, really strong profitability as measured by their cash generation and ROCs. Suvain and Polymedicure are two names which are more export rather than domestic. Suvain is like one of our holdings called Divi's Lab, which we've held for more than 10 years. It's basically an exporter of intermediates. And this China plus one phenomena that's happening around the world, where supply chain and chain managers are wanting to diversify out of China and have sources capabilities outside of China, is helping companies like Suvain. It has a strong history of the last 15 years, strongly a strong balance sheet, highly profitable, very strong connect with its customers, and we think that this can only strengthen going forward. Polymedicure is a case where so far it's been successful on the export side, but the government's push in the last 12 months, especially after the first wave broke out, towards making India self-sufficient in medical consumables has really been a shot in the arm for India's largest medical consumables company, which is Polymedicure. And therefore, it is not only going to continue exporting, but we'll see a lot of growth coming in from domestic markets. The last one is basically a restaurant chain. It's India's largest casual dining restaurant chain. It IPO'd recently, one of the very, very few cases where we directly took exposure at the IPO stage itself. Still a small position. We will watch it before it becomes a big position. I'll just take quick 2 minutes now to just recapitulate our hypothesis in terms of how we actually look at buying businesses. What are the key things that we look at when we hold on to them with conviction, despite the fact that they would have gone 2x, 3x, 5x, and so on. So Vishal, if we roll forward, two such cases in the portfolio. First one is India Mart, an exposure that we built about 15 months back. It is India's largest B2B marketplace, still very small in overall size, for the simple reason that while India has about 63 million small and medium enterprises, but only 11 million of them are digitally enabled and they use internet. Out of this 11 million, by the way, India Mart already has 6.5 million on their website. But the fact is that out of the 6.5 million, a small fraction, which is only 0.15 million, are the ones who are paid subscribers. The remaining, which is let's say 6.3 million to round off, are having storefronts, but they are still testing the waters. They still haven't taken subscription packages. But the fact is that the runway for growth is strong. India Mart has a 70% market share in B2B. As we all know, such businesses have very strong network effects. If you are there as a leader and if you are attracting the maximum amount of traffic, chances are high that you will continue, unless you make foolish mistakes, chances are high that you will continue in that pole position for long. That's the reason that attracted us towards India Mart. It continues to grow. The beauty is that despite being a new age digital business, the company doesn't believe in cash burn. The company has always believed in generating cash, which is shown on the next slide, where you can see on the bottom the bar charts, which are nothing but free cash flow generation. Even in a challenging year like last year, we saw free cash flow improving. I spoke about the power of the franchise to grow. The business has grown at 22% CAGR over the last 5 years. What's more gratifying is that the underlying paying subscribers growth is 16%, with only 5.5% being realization improvement. So the meat of the growth is coming in from growth in the franchise and growth in customer additions. Next, please. The second example I've taken is that of Avenue Supermart. Again, it's our top 10 holding. And this business is exactly similar to Walmart, to the extent that the owner of this business makes no bones and is very clear in saying that I have just copied the model of Sam Walton. I've even copied the name, like Walmart was named on Sam Walton. DMart is named behind the name of the promoter, which is Mr. Damani. And the business remains giving everyday low price to customers by virtue of having low sourcing costs, which reflects in everyday low cost. You source your merchandise low, pass on that benefit to the customer so that the customer, even after comparing, realizes that the lowest price are available only on DMart and therefore comes back to them. The beauty of this model has been that despite heightened competition in food and grocery retailing from the likes of Reliance Retail, India's biggest company, biggest conglomerate, I should say, Amazon, one of the strongest companies around the world, is attempting online model for food and grocery in India, and a few other specialized business models like Grofers and Big Basket and Walmart, which of course had acquired Flipkart in India and is also into food and grocery in India now. Despite heightened competition over the last 4 or 5 years, because all of these guys are wanting to gain market share, the profitability of DMart has only improved in each of the last 5 years. Not only has it grown, as I've shown here, 30% CAGR in profit growth, but 33% CAGR in profit growth and maintaining ROICs. The last point that I wish to make here is food and grocery retailing in India is a $500 billion market. All of these names that you see on this slide put together, which are all organized players, are just 5% of this 500 billion. 95% is still with the unorganized sector. You call them mom and pop stores. Like has happened in the West, this 95% will decrease and this 5% will only increase. The underlying food and grocery delivery market, food and grocery retailing market in India is growing at 7-8%. If you combine the shift from unorganized to organized, a strong player with strong focus on profitability, strong focus on everyday low cost can continue growing in the high teens for a very, very long period of time. That's kept us excited about the model of DMart or Avenue Supermarts, as it's called. I'll end my session here. I guess we can open up for Q&A now. So back to you, Praveen.
Thank you, Ajay. Thank you, Vetri. I think we have received a few questions from the audience. Maybe Vishal can ask them.
Yes, we have. Thank you, Praveen, Vetri, and Ajay for bringing us through the India economic macro growth story and for deep diving into the fund's strategy, philosophy, and the portfolio. We do have questions that have been sent to us by our participants ahead of the call, and we also are getting some questions coming in on the Q&A feature here on our webinar series. I would just like to share with the participants, if you do have any questions that you would like to ask our distinguished panelists, do feel free to put it on the Q&A feature that you see on your Zoom application, and we will be sure to answer it. First up, the question is for Mr. Vetri. What's the firm's view on the currency?
Sure. I think the thought process has always been that eventually the currency over the much longer term reflects the inflation differential, and simple way to think about it is US inflation and India inflation. And that would sort of suggest that the longer term trajectory, which used to be closer to 4.5%, should now come down, because remember, India is now targeting 4% plus or minus 2% inflation, and the US is actually talking about inflation being allowed to go well above 2% for some period of time. So I think, to my mind, the depreciation of the Indian rupee relative to the dollar should certainly be at a much lower trajectory going forward, simply because the inflation differential is also much tighter. I think from the point of view where people sometimes talk about things like the fact that the Indian currency was very weak during the taper tantrum, and is there risk that at some point of time, if the US Federal Reserve were to back away, would the Indian currency come under pressure? Very quickly, if you look at the data points of early 2013 and today, they look very, very different. If you look at the size of FX reserves related to the monthly import bill, there's no comparison. We are far more comfortably placed today at 15 plus months. In early 2013, that number was at about half of the monthly run rate, or half of that number. Also, if you look at the absolute size of the FX reserves, now above $600 billion, and simultaneously external debt well contained below that number. I think, both from a cyclical risk point of view, disturbances in global capital markets, I think the risk to the rupee is limited. And as I said, more importantly, medium-term structural trend determined by the inflation differential, 2 to 2.5% is what I think should be the rate going ahead.
Thank you, Vetri, for that. I'll now move on to the second question, and this is for Mr. Ajay. Could you kindly please comment on the past 3 months and year-to-date performance of the fund versus the benchmark, and in terms of either underperformance or overperformance these time frames, what would be your sort of view in terms of that?
Sure. Yeah. So Vishal, like I mentioned, basically over the last 8 to 9 months, we have seen a very, very strong value rally, especially post-November. And I think if I remember correctly, the first week of November is when the results for Pfizer and Moderna broke out, and the vaccine efficacy results came out post their trials. And ever since then, markets have been a very, very different creature. We've seen very sharp value rally. We've seen commodities fly. We have seen energy stocks driven by crude oil prices fly. And we never participate in these sectors. It's important for us to keep reminding ourselves that, look, we will not be able to outperform in all time periods. In fact, I would say nobody can. Only people who want to chase price performance would look at trying to outperform in each time period. But we all know that over longer time periods, such strategies never succeed. So we are always focused on the outcomes of businesses over a 3 to 5 year period, rather than what has been the underperformance or overperformance of our portfolio over the last 3 month period, 6 month period, or even for that matter, 1 year period, and so on. We would actually be bothered and concerned only when what we are holding in the portfolio is showing signs of weakness in terms of business outcomes over 3 to 5 year periods. If let's say the hypothesis that we have written for our businesses is not getting proven right, in fact, we are finding it difficult to actually live with the core hypothesis of our portfolio holdings. Those are times when we really get nervous and anxious. But otherwise, shorter term performance, these are phases which come and go. We are not too bothered about them. Like I said, our best reading of what's happened in the last 6 months is a very strong value rally where we have underperformed. Can the value rally continue for another 6 months? Possibly, yes. And we would still have no control over it. We would always want to focus on which are the businesses out there which fit into our hypothesis. Have we done enough to understand those businesses, or have we just left them out because we found it difficult to understand? We would actually be disappointed if we are not doing the hard work to understand great businesses which fit into our quality growth hypothesis and not get them inside our portfolio. So I think that's basically how I look at the last 6 months.
Thank you, Ajay, for the comprehensive answer and reply. Let's move on to the third question. This is for Mr. Vetri. How have value versus growth stocks performed in India in the past few months?
Yeah, thanks, Vishal. I guess, Ajay has already thrown some perspective on that. But I would still say that this cycle looks a little bit different from what I have seen in the past, where typically once you come off, trough valuations, remember the price to book on the Nifty 50, if you go back to late March 2020, was almost 2 standard deviations below the long-term average. Normally, when you come out of those kind of depressed valuations, you actually tend to see value names from those sort of depressed valuations do very, very strongly. But I think this time the whole cycle has looked very different compared to what we've seen in the past. In fact, as we came out of the pandemic, the stronger performance initially actually came from a lot of the names in technology, in consumer, because those were seen as strong balance sheets, they had very strong business models, and B, in some cases, businesses were actually not getting disrupted at all. As Ajay pointed out, it's actually in the last 6 months where there's actually been a bit of a handover from some of those growth names that led the rally in the early part to value. And therefore, it's a very different market if I were to compare this to the post-2009 recovery or even post-2013, where actually the value names led from the front in the initial part of the rally. Here, the roles have sort of, not played out similarly. Also, the transition has been rather rapid. So you've gone from trading 2 standard deviations below the long-term average to well above 1 standard deviation above the long-term average in literally, something like a 10-month period. So it's not resembling the kind of outcome you would see over a whole cycle. But to cut a long story short, typically stronger performance of value, as I have experienced it, tends to be from lower levels of aggregate market valuations. Once aggregate market valuations move much higher, the performance of value actually tends to run into a little bit of headwinds. If you look at the last 6 months, a lot of the strong performances in the value side have actually come from the commodity space, where we've gone back to record levels of profitability not seen in almost a decade. And I would actually be a little bit suspect about this playing out in terms of a sustainable trend, because just as policymakers believe that some of these supply disruptions are transient, if that case is true, it has implications not just for monetary policy, but also for the profitability outlook of these commodity companies who benefited from the disruptions, but perhaps doesn't necessarily change their longer term, pricing and profitability cycles. So yes, value has been very strong in the last 6 months, but this cycle does not look like the classic cycle that we've seen in the past, where actually value leads from the front, from the outside. But having reached aggregate valuations, which are, as I said, well above 1 standard deviations above the long-term average, I actually think at this point, value will find it slightly difficult to continue to lead the outperformance.
Thank you, Vetri, for the insightful response. The next question to Mr. Ajay. The fund and the strategy has grown considerably a lot in a year. The first part of the question is, how do you handle this increased AUM? And secondly, does this have an impact on your investment process?
I think that's a great question, and we keep getting asked this question because, of course, the strategy has grown in terms of the overall AUM very sharply over the last few years. But see, there are a few points which I want to reiterate. Point number one, size will be an anchor for all strategies, likewise for us. But size is a bigger challenge for people who have a high portfolio turnover ratio, whose investment philosophy is about going out and hunting for mispricings, taking advantage of that of those mispricings by holding on to the investment opportunity for 6 months, 9 months, 12 months, and so on, and then flipping it over once that mispricing is done and prices are closer to the value, and repeating the same exercise in some other investment case or investment opportunity. Ours is a case of identifying businesses rather than simply mispricing. In fact, I've said this more often than not, when we buy these high quality, high growth businesses, we are buying them at a premium. Rarely does it happen that we are buying them at a discount. And the idea of owning them is that these businesses over sufficiently long periods of time will really generate very strong economic value, which will help us generate wealth. As a result of all of this, our portfolio turnover ratio is just about 10 to 15%. We are extremely gradual on the way up, which means, and I showed that to you in one of the slides, the 6 new ideas that we bought in the last year, except for 2, the other 4 are around 60 to 70 basis points in size, and they may or may not hit 1% even over the next 6 to 12 months. So that's how gradual we are, because if these opportunities are really multi-year opportunities or almost like a decade-long opportunities, we don't want to rush ourselves into them at any price. We will keep building exposure gradually. This is the most important point that has helped us handle size. And even at this juncture, size is really not a constraint. What keeps us awake at night is certainly not this growing size. What keeps us awake at night is that have we done a strong enough test for our key parameter, which is quality, or are certain businesses in our portfolio coming in as businesses optically with high ROC track record over the next 5 years, but may not be able to withstand the onslaught of competition over time. Like it inevitably happens, capitalism over time ultimately leads to strong ROCs being faded away and majority of businesses coming to the cost of capital. Now, this is the biggest fear I want to reiterate that we always hold. Hopefully, if businesses don't come all the way down to cost of capital, we should be fine in terms of both handling size and long-term wealth creation. So size is clearly not a worrying factor for us. Yeah.
Thank you, Ajay. Yes, indeed. I'd like to move on to the next question we have on our cards. This is again to Mr. Vetri. Now, despite the second wave of COVID-19 in India, the markets have been resilient. Do you expect any correction anytime soon? And in that regard, what would likely to trigger a correction? And the final part of the question is, what are the main risks to India's investment case? Do you see oil prices or an increase in non-performing loans or any other risks to the financial sector do you see forming besides the emergence of maybe a second or third wave of COVID-19 in India?
Sure. This must rank as the most frequently asked question, particularly over the last 1 month, with all investors, whether it's foreign or local. I've sort of grappled with this myself because, as I said earlier, the second wave has been very, very personal for each and every one of us, here in India. It sort of raises the question, is the market being immoral? Is it ignoring the situation on the ground? And, if I just go back and look at the data, and, that's what I did, go back, look at what happened in other economies when they had their second wave. And we know that there are some countries who've even had a third wave. And it was instructive to me as well to go back and look at what happened in those countries, because it pretty much looks to be the case that for whatever set of reasons, markets in those countries did not really blink during their second wave, or for that matter, their third wave. And perhaps because of the kind of liquidity support and fiscal support, policy support being provided by the authorities, markets have just sort of powered their way through that, along with the optimism that, the vaccines will put economies back on track again. So I don't have an answer for that, but except to point everybody back to the history that none of the markets around the world have really taken a significant setback because of a second wave or third wave. And perhaps that's what is at play over here as well. I don't have an explanation. I don't have an explanation that I can use to justify it. It is what it is, and you just move on. So what are the risks? I think the first wave in India, the second wave as well, as much as the stock market is a reflection of corporate profitability, and corporate profitability, remember, as I said earlier, if I look at the period 2020 to 2022, which is a 2-year period, most likely the Nifty 50 finishes up with earnings being higher by about 35 to 40% over this period. Obviously, the 22 is still a forecast, but that's what the forecasts are pointing to. GDP actually unchanged over this 2-year period. So I think to say, looking at the market, that the economy is in fine fettle would be a grave error. Either my error if I took that conclusion, or if policymakers took that conclusion. I think clearly there is pain in the economy. It's there in the unorganized sector. It's there in the informal sector. It's there in the services, the urban services sector. It's brought to the forefront the poor state of health infrastructure, not just in rural India, but also in the big urban areas. So I think these are all very critical points that government will have to handle. And I think as government starts to sort of get a full sense of the pain, they will have to support a large cross section of the society, which is not experiencing the sort of V-shaped recovery that some segments of the economy are. So to my mind, it is that fiscal pressure which is likely to come on government, the need for them not just to do something, but to be seen as doing something. I think that, to my mind, is the most critical piece that the government needs to address. Not so concerned about the financial sector. I think, very unlike past cycles, this time we came into a problem having already seen 2 years of a slowdown in growth. The banks preemptively provisioned, they raised capital, and they have built buffers. So I'm not so worried from a financial stability point of view, but I think certainly some kind of increased social sector spending is called for. And in that context, what we can't forget today is that our debt to GDP has gone back closer to 85 to 90%, right? Now, unfortunately for India, fighting that 90% debt to GDP can't be done by fiscal austerity. As we've seen in the past, growth is the best antidote to addressing that kind of an elevated debt to GDP ratio. And I think therefore India has got to go all in on a growth bet one way or the other, using reforms to unleash productivity gains, using reforms to unleash entrepreneurial energy. And that, to my mind, is really the challenge that we face as an economy, to get each and every one of our citizens to participate in the growth that we are all looking forward to.
Thank you, Vetri. Yes, indeed. That was very comprehensive and a meaningful response. Now, I'd like to open up the next question to both of you, both Ajay and Vetri. There is a strong global interest in closing down coal power plants. But as you can see, coal is abundant in India, and it makes sense to utilize it compared to other alternative investments, which also have their own pros and cons. Most importantly, coal industry is also a large employer. And if considering supporting the company, do you think it will be challenging for individuals to find jobs in the coal industry? And with regards to this, what is your outlook with regards to coal and the wider energy industry in India? And is there an investment theme relating to this?
Yeah, that's a pretty tough question to address. But let me just say this. I think from India's perspective, coal is really a source of energy. which is available locally. We have the, I think, third largest coal reserves in the world. May not be all of it high quality coal, but certainly it's, a very large domestic source. The concern, if I can call it that, is unfortunately, given rising environmental concerns, and correctly so, it's not clear to me that we'll ever get all this coal out of the ground and put it to use because of, the government's own stated objective that they need to bring down the contribution of coal as a fuel to energy generation and other uses. Will that have a significant negative impact on employment? Maybe not to that big an extent, because honestly, coal mining has for long been the preserve of the public sector, which is government-owned companies. This was undone only about 2 or 3 years ago. They've opened it up now gradually to the private sector and also to complete merchant mining operations. And I do think that the job creation by private sector and by merchant mining can offset some of those. The simple fact that the government, as an employer in the coal sector, anyway was not really adding jobs very significantly. But to my mind, it is not that dramatic a number that it really moves the needle at an economy level. I think the much bigger challenge for India is the migration of labor from the farm sector to services or manufacturing or construction, which is very often the entry level occupation to which they move before moving into more skilled occupations. To my mind, that's the much bigger challenge for India than anything relating to coal mining. The government has also articulated a whole set of policies to try and incentivize the producers to set up increased renewable capacities in India, and also manufacturing of renewable capacities in India. So I think it is a welcome transition. Ajay spoke about pharmaceutical companies. We know how much of some of those companies make their profits from respiratory related drugs, and many of the cities in India would qualify as being absolutely and positively unhealthy for anybody whatsoever to even live in. And mind you, we live here 24/7. So I think when you look at the aggregate of the costs and benefits, there is no option for India but to gradually move away from the dependence on coal. And some of these government policies are hopelessly putting us on the right track to getting there.
Thank you, Vetri. Ajay, would you have anything to add to that response?
Sure. I think Betty has just answered it, and I have the same thoughts. But a quick reminder to us, to all of us here, that while people look at all of these things as reducing employment and increasing unemployment, but do remember improvement in productivity is also a very important measure of increase in growth for any economy. I'm just reminded of the 1980s, when possibly many of us would have had the same doubt when computerization first happened in India, and it was tried into an institution called the Indian Railways, which is one of the largest organizations in terms of the number of people that they employ. And people felt that a lot of people will get unemployed in the Indian Railways, rendered useless, and so on. But we all know that all of those things were proven untrue. Computerization actually helped railways become much more efficient. Those people gained certain skill sets, possibly within railways, or they were employed elsewhere, and the overall economy also benefited. So I don't think just because something is taken over from one particular area, which in the short term may be looked at as leading to unemployment, is necessarily negative in the long run. Yeah.
Thank you very much, Ajay. The following question right now is again open to both Ajay and Vetri. The agriculture reform put forth by the government saw demonstrations in New Delhi. Now, with any reforms, there are winners and losers. Could you update on the current situation, also provide your assessments in terms of the costs and benefits of the reform? And also, would the reform redistribute wealth from middlemen to the farmers, as some have put out, or would the farmers suffer as a result of this? And is there an investment theme regarding agriculture on the whole?
Well, many questions in there. Let me just try and address the ones which we have clearer answers to. Yes, there have been protests, but I should point out that the protests are not national, because some of the laws which they have touched actually perhaps did not matter to farmers in maybe almost maybe a half or 40% of the country. So it's not like these are being resisted nationally. Having said that, we are in a bit of a strange situation. Constitutional experts tell me that they've never had a similar situation before, where the Supreme Court intervened on a law passed by the government, and it has been put into something they call suspension. We don't understand what it means from a constitutional or legal point of view, but fact remains the central government is not pushing the agenda right now. They've allowed the Supreme Court suspension to sort of stay. But because agriculture is also a state subject, some of the states have continued to drive some of the reforms in that policy domain. I do think in aggregate, the policy measures that government took eventually would more likely benefit the farmers. And it would be good for both farmers and consumers, because it would enable a far more efficient and a sophisticated supply chain, cutting out some of these middlemen who were sitting in the system. Now, that's not to say all middlemen are bad, but certainly the system was not efficient, and it was not, productivity was very, very low. Wastage was very, very high when you think about the farm to table argument. So I think eventually this will be a net positive for the economy in terms of gains accruing both to consumers, the retailers, perhaps, if they're able to build the supply chain, and eventually the farmers as well, because it potentially gives them a superior farm gate prices. Having said all of that, to my mind, maybe some of the debates over the farm laws being undone last year are slightly academic right now because of one of the slides I showed you, which is that global food prices have gone above the domestic level. And that's interesting because if you remember, during that 2006 to 2012 period, Indian farmers benefited from strong global prices. They became the swing producers and actually exported a large quantity out of the country. So I think, a good pricing outcome for farmers may just dilute some of the pressures from farmers in terms of fighting these farm laws, because, if they're doing well in terms of incomes, then, they may not really oppose these laws to the extent that they were last year. So that might come as relief to government. Are there any plays from a stock market point of view? I'll let Ajay add there. But certainly, I think some of these companies which are either working the supply chain space or retail companies who are trying to build the supply chain, I think some of them will end up creating strong business models, and they'll be able to, create value for shareholders by, getting rid of some of those middlemen who perhaps were not adding as much value. So I think that's where in supply chain logistics and retailers who build that supply chain could create value for ourselves. Jay, do you want to add anything?
Sure. No, I think Vetri have covered it very comprehensively. Just to add that, yes, like all business cases and opportunities in India, we would try and analyze the opportunities that will open up because of these farm laws eventually with a very fine comb. There could be cases of food processors who would now be allowed to actually procure the produce from the farmers directly, and therefore become a little more efficient in terms of their processing plants. If such a business does come up, which has shown strong track records and connect with the farmers on the sourcing side, we would be open to look at such opportunities. So let's wait and see how this unfolds over the next few years.
Thank you very much, gentlemen. That concludes our questions that we received ahead of the webinar session. I would like to now turn to the questions that we have gotten as we started the event about an hour ago. And again, I'd like to remind our key participants and clients, if you do have any questions, feel free to utilize your Zoom app there under the question and answers function to let us know any questions that you have, that you like the panelists to be answered. Now, the first question, I think definitely this will be for Mr. Ajay. The fund has not had any major correction this year. Is it a good timing to invest in the fund right now?
I can already see Vetri laugh at that question, and I would say that this is one of those questions which is, you see, if you ask me to be very honest, I would say, look, none of us have an idea where the markets are headed. None of us have an idea, in fact, where even our portfolio is headed in terms of stock prices of what we hold there. Yes, overall markets have done very well. The portfolio has also done very, very well. And at this juncture, the one clear message that I can give to any investor is certainly not the time to make lump sum investments into our strategy. Should you continue with those systematic investments or spreading out your money over, let's say, a few quarters? I would say this is as good a time as it ever was, because if you ask me, I've been saying markets have been expensive right since December of last year, and it's been 6 or 7 months. Markets just continue to behave the way they've behaved in the last 12 months. There has been no case for a strong correction. Various global events have happened. We've gone through a very strong second wave. It again just tells us how unpredictable this thing is. The more we get systematic and have a plan to invest into a particular asset class, the more scientific it gets. And therefore, I would say avoid lump sums at this juncture. This is not an attractive market as it was same time last year. Also not a strong case to say that, look, we will just not make any incremental investments into India. We'll wait for 6 months. Yeah. I don't know whether Vetri wants to add to this.
Just to add to what you said, Ajay, yes, I mean, I very simply, I don't think we are experts in being able to figure out when the market will, correct and when it will rebound. So, which is why we don't try to necessarily, we don't have any skill set to advise anybody on that, including ourselves. So we don't try to do that. And I think, as Ajay pointed out, one could have been arguing the same valuation metrics we look at. They've been telling us that things are overextended for quite a few months now, but the markets just refuse to have a significant pullback. So yeah, I think the simplest thing to do, and this is, the advice we give locally to a lot of our investors as well, or to our, rather I should say, the advisors and distributors who work to us, is just spread out your investments rather than trying to, fine tune it so sharply.
Understood. Thank you. And I'm sure our investors will greatly appreciate your responses to our last question. Now, again, I would like to ask both of you gentlemen, what are the steps that the firm is taking to ensure against inflation and rising interest rates that does not affect the equity funds negatively?
I'll quickly respond from a strategy perspective, then Vetri can give a more comprehensive answer. From a strategy perspective, it's very, very simple. You see, if we have really gotten quality businesses into our portfolio, and there are many reasons for these businesses to be called as high quality businesses. One of the very, very important reason is having pricing power. Raw material prices increase, may not be the same day or the same week, but the brand, the business, the product or the service should have the ability to pass on the increase in cost of doing business to the customer, and the customer should be able to accept it. That's one very, very important moat that our businesses have. And therefore, I would say a rise in inflation is not all that negative for these businesses, because over time, they would actually affect an increase in their end product prices because of increasing raw material prices. Don't forget, the base case for us is that the volume growth in the franchise should continue happening. If on top of that, there is a price increase, which has become imperative because overall inflation in the economy, it only adds to the nominal growth of the business, both in terms of revenues and profits. For a more comprehensive answer, maybe Vetri can actually reply.
I mean, without getting into the macro, Ajay, I just wanted to add that I think particularly from the point of view of a rise in interest rates, I think the IDEF portfolio is pretty well insulated because we don't really own any companies in that portfolio which are significantly leveraged, and therefore there's nothing in that portfolio where one could say that because of a rise in interest rates that company's business or its future prospects would get diminished, because anyway most of the companies in that portfolio are free cash flow generators, rock solid balance sheets, and in fact the net debt to equity, when you see the portfolio as a whole, it's actually in the net cash in terms of the portfolio, so excluding the financials, of course. So from that point of view, I think this is a portfolio which is quite well insulated from a worry about the cost and cost of money going.
Understood. Thank you, gentlemen. Now, I think this would be our final question for the session here. Again, this is open to the floor. With the lockdown easing in many cities, is the Sensex expected to move to new highs? Currently, we see the Sensex range bound between 48,000 to the 52,000 level area. Do you see the index moving higher as restrictions are eased across the nation?
I'm not great at calling these short-term things, so I won't, but I would again just point out to you that right through the worst point of the second wave through May, the market continued to rise. And in fact, I was pretty surprised when I saw the end of May report, which says that India was one of the best performing markets through the month of May, when the news was really, really painful in terms of the second wave. Having said that, perhaps the old market adage comes back, which is, buy on rumor, sell on news. So maybe the news of, the economy coming back fully up to speed might prove to be just what the market needs in terms of cooling off some of those, overexcitement in the stock market. But again, I'm not an expert.
Okay, do you have anything to add to that?
Just very quickly, I'll just reiterate what Vetri said, but just in short, if we never fell when the numbers were horrifying and the numbers were surprising us, then why should we rise when the numbers have moved in the other direction? So I think from that perspective as well, we don't see any reason for market has a mind of its own. I don't think one single factor can ever explain.
Understood. Thank you very much. We have covered all of our questions. Again, a very big thank you to our distinguished panelists, Ajay, Vetri, and Praveen. And I'd like to thank all our partners and clients for joining us on this webinar series. And it was really great to bring through everyone the India continued growth in the macro story there, and for sharing the insights into the fund's philosophy, investment themes, and the strategy. On behalf of UTI International, I'd like to thank all of you all for joining us for this session, and we'll hope to see you soon. Take care and stay safe. Thank you very much.
Thank you. Thank you, everybody, for joining us today. Thank you.
Thank you. Thanks, everyone.
Thank you. Bye-bye.